study up on this owl. Whoops.
No, you're good, Cal. Well, with that, we're a couple minutes into the hour. We've got a good selection of attendees, and thankfully, as we all just heard, this session is being recorded. HDR has done a great job of posting and hosting these Be Your Best series available for people to attend in person, but also to have access to thereafter. So thank you everyone who is here with us live today. We are excited to have you here, and we will get going and things. But if you're watching after the fact, hopefully here in the near future, that owl has been captured and returned to the zoo and is safe and sound and happy and healthy. So anyway, so Richard, I'm going to turn it over to you to get us started for the HDAR and OneKey side of things.
Brian, thank you so much. And as always, welcome everybody. Welcome to the Be Your Best series, our webinar series to share best practices for getting real estate deals done in New York. I'm Richard Haggerty, CEO of OneKey MLS, the comprehensive multiple listing service for the New York region. OneKey has more than 46,000 subscribers and serves the region from Montauk to Manhattan to Monticello. OneKey hosts the Be Your Best series with the Hudson Gateway Association of Realtors, which represents more than 14,000 real estate professionals in Manhattan, the Bronx, Westchester, Putnam, Rockland, and Orange counties. Today, we'll be crunching the numbers to see how the market's shaping up 6 weeks into the new year. Our panel will weigh in on the economy, interest rates, inflation, and other important statistics to help you get deals done. As always, Brian, I'd like to thank you, President of TitleVest, for partnering with us on this series and moderating our panel discussions. TitleVest is a leading New York City-based title insurance agency and member of the First American family. TitleVest offers a full range of services for real estate property purchase and refinance transactions. TitleVest has offices in Manhattan and Westchester and engages in transactions upstate, downstate, and nationwide. TitleVest has won the New York Law Journal's Best Title Agency for the last 10 years. And now let's meet our panel. And I believe in this instance, everybody is a return guest. First, we're pleased to welcome Marissa Tracy. Marissa is the Managing Director at First Republic Bank, a private bank and wealth management company. Also joining us is Jonathan Miller, President and CEO of Miller Samuel, a real estate appraisal and consulting company. And we also have with us Cale Goodman. Cale is President and CEO of MarketProof, a real estate intelligence and analytics company. Cale, Jonathan, Marissa, we're so happy to have you all back. And Brian, I'm going to throw it back to you.
Thanks, Richard.
Wonderful. Well, thank you, Richard. And yes, as always, excited to be here, especially with like such fun panelists as we've got today. I'm really excited. A huge shout out and thanks to you, Richard, Jeff, Kathleen, and the whole HDAR and OneKey teams for creating this series. It's really been a lot of fun. The last couple of years we've been doing it. Looking forward to many more to come. A few housekeeping items for everyone in our audience today. Questions are extraordinarily welcome and encouraged. Please use the Q&A function, which depending on what kind of device you're on, will either be at the bottom of your screen or possibly touch, and it'll be at the top as a little drop-down menu. It's 2 little chat bubbles hanging out over each other with Q&A. Submit your questions there. We'll see them queue up. I'll be coordinating them to sit in line with the flow of our conversation today. So I don't get to your question right away. Don't worry, we'll still weave it in. You're welcome to use the chat function, as some of you have already been doing today, to chime in on sort of like accolades or agreement or another thought. But if it's a question you sort of really want to ask the panelists, put it into the Q&A function. Otherwise, everyone on their line will remain muted. We found that's the way that works best here, but we look forward to hearing from all of you. And before we dive into our content for the day, Richard, I'm going to come back to you for some update on the stats and market moves that you're seeing from the sort of amazing tool side of things and all the data you have coming out of the OneKey side of it.
So yeah, I'm going to sound like a broken record, and I'm going to continue to sound like a broken record probably for the next several months. If I were to look at these numbers and not have the context, I would be doom and gloom looking out the window, wondering if I should jump out. I mean, just looking at the 9 counties that we cover in terms of number of transactions, Putnam is down 28%, Rockland 38%, Suffolk 36, Orange almost 37, 37, 41, 19 for the Bronx, Westchester 28%. I mean, those just would typically be staggering numbers. However, what are we comparing them to? We're comparing them to January of 2022. And those were transactions that were actually negotiated in either the third or fourth quarter of 2021, which is a historic year. And we're not going to see the likes of that again, would be my suspicion. So we have to put that in context. We did see a trend throughout last year where we started out really, really strong. Part of that because of 2021 bleeding over into 2022, and things started to decelerate. And certainly we saw a lot of that deceleration in the third and fourth quarter. So we're seeing a product of less activity in the third and fourth quarter of last year. So I am not overly concerned at all. I really think that we're still going to see a very strong spring market because I think buyers have been on the sidelines waiting to see what happens. But now that we've got stability in terms of interest rates, which I think is going to continue, I think that we're going to see a lot of activity, not going back to 2021, but just a solid amount of activity for the spring market. Prices have stabilized. Again, looking January to January, Putnam down a little bit, Rockland up 7%, Suffolk up 3% almost, Orange up almost 6%, Queens down 2%, Bronx down almost 6%. So prices are a bit of a mixed bag. And I do think that we're seeing prices start to come down a little bit, but I'm not seeing a lot of price deceleration as we go into the spring market. I think that we'll continue to see stable prices would be my guess.
Okay, interesting. Well, on that topic of interest rates stabilizing, we're going to turn to our resident banker, financial guru extraordinaire, Miss Marissa Tracy, with First Republic Bank. So, Marissa, you've got your finger on the pulse like few others I know. So, give us some thoughts on what you and the team there at First Republic Bank are seeing and projecting on the interest rate environment.
Sure. Nice to see you all today. So there's been a lot of movement and a lot that's happened actually just in the last week or two. We had the Fed raise Fed funds rate again on February 2nd to 4.5%. That was a 25 basis point rise. There were 8 Fed rate hikes since March of 2022. Notable here, almost all of those rates were in the 75 basis point range and then 50 basis point range. So to think that we're now only raising by 25 basis points means that we're finally slowing down and approaching what we talk about as that terminal rate, which is the rate that the Fed funds we think will stabilize. Powell has been very chatty though, and given us a lot to think about. And he's said pretty clearly that he is not done yet. He expects rates are going to be higher for longer. He does not see any rate decreases in 2023. And in fact, what the market is pricing in at the moment is 2 more Fed rate hikes of 25 basis points each by May, which means that we get to a terminal rate of 5%. And if all is good, we're going to stay there. What you're seeing though in the market, and especially in the stock market, that's been pretty interesting though, is even though the Fed and Powell has said specifically, we are not decreasing rates this year, the markets and Fed futures have actually been pricing in rate decreases. So as of a week ago, expectation was that we would end the year in Fed, at least Fed futures expectation, in a 78 basis point drop to rates. That has since changed significantly. And now the market is only calling for a 33 basis point decrease in rates by year end. Again, I've been doing this a long time. And it's famous saying, don't fight the Fed. I think that Powell has been really clear that he is not dropping rates this year. And that 5% terminal rate is probably where we're going to be. There's been a little bit of extra noise because we had Kashkari, who is the head of the Minneapolis Fed, come out this week and actually say he doesn't think a 5% terminal rate is enough. And he is now the 3rd Fed governor who's calling for a terminal rate higher than 5%, who's actually calling for 5.40. So we think given all of that sort of noise and commentary, I think 75 expectation in the market that we have 2 rate increases by the end of May, and a terminal rate of 5% is probably where we're going to be. And all things considered, the reason that the Fed is not dropping rates, even though the market has been talking about it, because a lot of people have been asking that, is that they don't want to ease rates based on a drop in price in goods. Drops in price in goods kind of leads the way into a disinflationary environment. But what they're looking for is they're really looking for a drop in services, as well as a drop in wages. And that takes longer to be shown in the market. And so the worst thing the Fed could do would be to ease up on decreasing rates and then have inflation start to take off again. And actually this week, we had a number that was showed a much stronger jobs report than expected. And so that's kind of supported the fact that this last Fed rate increase was the right thing to do, and that we'll probably see 2 more by the end of May.
Great. Very well summarized. Kale tagged something into someone's questions who came up into the Q&A. And Gary, I've just sent it over to you. If you don't mind dropping that hyperlink into the larger attendee group chat. It's a link to some of Kale's company's Market Proofs year-end reports that I think help visualize some of these things you're covering, Marissa, which is excellent. So I want to, Marissa, I've got some questions for you to come back on the Powell commentary side of things. Before we do that, I want to go over to Kale. Kale, you had some very interesting comments on how these raising rates are influencing the different asset classes. So I'm going to turn it over to you.
Well, hey, everybody. First, Richard's comments were, it was a great summary. And I'm just what I just shared, I'll just pop that up on the screen here. So in, just starting out in the new development space, so we published our year-end market report a couple of weeks ago. That's the link I just put in the Q&A. And in here we have some charts. And this is, I love this chart because it shows you what happened, but it also sort of hides what happened a little bit. If we look at it on an annual basis, kind of building on some of the things that were just talked about with interest rates. So what we did is we created a benchmark based on the pre-pandemic average from 2015 to 2019, which was a pretty stable period with ebbs and flows throughout those years, and kind of the line that you see going across is the average of that time. And so at the beginning, right at the beginning of the pandemic, you see that drop in 2020. And then with the cheap money out there, we saw this remarkable resurgence, right? And so as Richard was saying, that's kind of that, hitting the brakes and going into your seatbelt pressure you see in your chest. And so we just don't feel like it's the right thing to do to compare to last year, even though obviously we're all feeling that.
Yeah.
So you see that big increase and then it dips back down. But the truth is that in 2022, something like 2/3 of the deals happened in the first half of the year. And so what's happening now is kind of the pendulum, is swinging the other way. And now that we're kind of into the beginning of 2023, the pendulum has kind of swung kind of past the equilibrium point a bit. And we're actually now a little bit below the trend line. But what we're seeing now is, as we'll hear from the panelists, is people are starting to dip that back into the market now, and we're starting to see things kind of come back the other way. So anyway, so to kind of go back to one of the points Brian was making is that across all asset classes, we see this pendulum swing. I'll hold off on going too far into commercial or other things for this panel, but just the point is that it affects all types of real estate, not just residential.
Yeah. And one of the things, so Marissa, to come a little bit back to you, and Jonathan, I think this tees up for you to follow is, as we see those sort of like that volume change, what does that lead to as you're thinking about, Marissa, and sort of you're advising your clients and helping give them perspective on, buy now, hold, sell, sort of directionality as you see interest rates influencing pricing, influencing market volumes. How do you translate it into some of that, what to do kind of directionality?
Yeah, I think that there are a lot of things to take into account there. So one thing is, right, returns. So the S&P is up 7.9% year to date as of today. First Republic and most of the financial institutions, large financial institutions, are only calling for single-digit returns in the S&P this year. Lots of volatility, but single-digit returns. So we may have already seen most of what we're going to see in the equity market. Technically, right, we're at 41.44. The next kind of level is 4,300. If you get there, we're at 19.5 earnings. That's just really expensive. So I think as you start to look at asset classes and you're talking to clients about where to be deploying capital, real estate, especially if we see prices start to correct, makes a lot of sense for a lot of clients. So then we talk about financing, and the prime rate is at 7.75. That is a very high number. And clients are hearing those numbers and scared of the market. But we're really back to a time where relationships matter. And at least, for me or with my clients, if you have a relationship and are interested in having a relationship with me, we have 3, 5, 7, and 10-year ARM mortgages that are still below 10%. And people are shocked to hear those numbers. And then I think also, we're having a lot of conversations with clients about what makes sense for them. Is it an interest only where their payout is significantly less, especially if someone's moving out of a large rental property and thinking about buying? Does it make sense to do a 5 or 7 year adjustable rate mortgage and let us get through the next interest rate cycle? The market is pricing in, we have a very significantly inverted yield curve. The market is pricing in that within the next 10 years, rates are going to be significantly lower than when they are now. So we're talking a lot about thinking the way we did in the early and mid 2000s about buying and locking in a rate for a cycle and then thinking about refinancing much more than we are talking to clients as we did 2 and 3 years ago about this is the lowest rate you may ever see in your life. Take a 30-year mortgage and lock it forever. And that's really the conversation that clients need to sort of get their hands around to get comfortable about buying in this market again. Brian, you're on mute.
Yep, sorry. You talked about this when you were catching up previously about how it's like a change of mindset. We spent so many years in this mindset advising our customers and clients that, hey, this is the best you're ever going to see, lock in and like lock for 30. And now we're going back to a mindset that is from years ago, but very common in the larger history of things, which is like, hey, snag the property you want at this rate and then wait for the right moment to refinance that rate down and look at the sort of cost value of that over time. And I think there is more to explore on that. And you've touched on some prior panels that the relationship pricing, helping you beat that, not unfortunately get swept up into the 7s or the 6s or 5s, but help get you back down to the low 5s and 3s kind of zone that helps make that real estate investment feel more affordable relative to the price point we're still at, because as Richard said, the prices haven't dropped that much.
Right. So I think that in this market, certainly, 2 and 3 years ago, rates were so low that it was really all about rate and kind of where you could get the best rate. I think now there really is an advantage to working with a banker, having an agent call a banker or bring them in early to help explain to a client kind of what it could actually cost, what their various financing options are, and get an understanding about what that actual cash flow is going to look like to them. For my clients anyway, in the conversations I've been having, with agents who brought me in. It's helping clients, get off the seat and make a decision.
Yeah. Jonathan, I want to turn to you. So Marissa's just given some good, information that is applicable across the country. You in your practice have a lot of coverage in other markets. I do want to come back to the nuances of the New York City uniquenesses, but let's start with from you. What are you seeing as you look out at a whole bunch of the US markets out there more broadly as these interest rate factors are playing out in those markets?
Sure. Well, as much as we like to think of New York Metro as being unique, it's very similar to the 40 plus housing markets across the US that we cover every quarter. The key characteristic and what makes this so different, and which was illustrated in Richard's comments to open this with, is that first of all, there's two things. First of all, the narrative on the housing market that consumers are feeding into is far more negative than I think is actually happening. And that's because there's such a reliance on year-over-year comparisons versus comparing to pre-pandemic conditions. That's number one. And I think, it really skews it doesn't provide the proper context. I'm always a believer in year-over-year comparisons because you control for seasonality. But the problem is, as we saw in Cale's chart, that 2021 was a rocket ship, nothing less than that. And so to compare against an historic anomaly is silly. That being said, what makes this very different in sort of market pivots is that inventory is chronically low. In fact, in Westchester, inventory is the lowest on record that we've ever seen. And we're seeing this across almost every housing market. If it's not the lowest, it's the second or third lowest in history. And the reason for that is that rates were too low for too long. And people became wedded to that low rate, as we've all sort of talked about. The question is, how does that impact? Well, normally in a downward, activity cycle, you have an external event, you have sales drop, spike in rates. Rates are double, even though they're down a full point since the fall. They're double what they were a little over a year ago. So the way to look at it is that low inventory, and I think about this in conversations with the buyers, is that in low inventory conditions, there's a firm underpinning under pricing. And this is something that I've been saying, for the last 6 months. And it's really showing to be true. Yes, you have some markets where you see some downturn, but it's single digit. We're not talking about the word correction. If you heard me in 2009, it was a very different conversation than what we're having now. There just isn't enough supply, and there's lots of reasons for that. But the bottom line is, and this is why I'm not in sales, because I dubbed 2023 as the year of disappointment. And what I mean by that is sellers aren't going to get the price that they might have gotten in 2021, and
Right.
Buyers aren't going to see a massive improvement in affordability, with the current rate environment. And I'll just make one other comment to sort of dovetail into what Marissa was saying, is unemployment's 3.4%. Who on earth is thinking it's realistic to have a rate cut in 2023 when you have almost the lowest unemployment in history? And the reason why the Fed is still doing this sort of little uptick in quarter point increases is because unemployment is at record lows, right? And very high comp relative to the last couple of years. And the way to think of unemployment being so low is that since the late 50s through the pandemic, wages and employment were like a deflationary. They were like pulling things lower. So we had low inflation overall. Post lockdown, it's just the opposite. You know, it's inflationary. You know, there's more wage growth and very low unemployment. So I think you have to, in your mind, just think that not much is going to change in terms of rates in 2023 and even maybe early 24. But remember, at the same time, that's a sign that the economy is very strong, stronger than I think the Fed is comfortable with. And that's where we are.
Okay, interesting. You know, I was just on a board meeting immediately prior to this for a fast growing, and they're looking at doing a lot of hiring in the new year, prop tech company. And, you know, we were talking about this wage thing and like hiring talent and that wage growth it is hard. There's still, even though there's layoffs in sectors of the market, it is not a broad-based thing that has really changed the unemployment metrics.
Right. And Brian, just to jump in, like everybody on this call is hearing every day, every couple of days, like 10,000 people are laid off from this tech firm and 20,000 people here. The problem with that is, like, for example, Amazon during the pandemic brought in 750,000 new employees, right? And I forget what they laid off. It was like, call it like 15,000 or 20,000. So this is the point of context, is you hear this press call, this press, you know, headline that says, you know, Amazon lays off whatever, I don't remember what the number is, 17,000 people or whatever, or Facebook lays off 12,000. They don't tell you they hired 300,000 or 30,000 or 60,000. It was wildly sort of, they overstaffed during the pandemic. And so as sort of a net number, it has a very small impact on the total number that, you know, even with those seemingly huge layoff numbers, unemployment is still extremely low.
And it was also, though, a very important correction for the tech industries. I mean,
or they wouldn't survive, right?
Yeah. I mean, this is almost really going to truly benefit the economy overall, I think, going forward, because they needed to do this.
Yep. They acted like they were responsible, like they had to keep their business ongoing, right?
You know, this is leaving our topic here, but I think it's an interesting thing. I'm very excited because I think that one of the things that will come out of these layoffs, an unfortunate circumstance that can bear interesting fruit, our transactional real estate world has not been on average, has not been nearly as highly influenced by technology innovation as many other industries, right? We've got a little bit of like historic average, like slow adoption rates in a whole handful of things. And I've read a couple interesting articles that are talking about this large tech layoff wave we're seeing right now being something that's going to lead individuals who were laid off, who were sort of golden handcuffed into this really cushy, great job, right? During the last couple of years, great pay, work from home in your pajamas, you know, do whatever you want kind of stuff. And so they weren't leaving and taking their innovative ideas and sparking a new company. So we've had a lot of, it's almost like our housing starts stat turned to like new company entrepreneurial starts has been low. This is going to spur some of that like new company startup space in the coming years. I mean, and I'm like excited about what we're going to see in like 3 or 5 years as those ideas turn into a little bit of funding, some fruition, some garage workshop stuff. And like all of a sudden what we're doing in our transactional world is different in 3 years.
Well, I think just to add on to that is job openings are double the unemployment rate. So meaning that for every person that get laid off, there's 2 jobs that are unfilled, which is, so you're not seeing a long time for people between jobs because of that disconnect. So it's a really fascinating time.
Yeah.
And also, Jonathan, just to add to that, the jobs report, which came out, showed average earnings 4.4% higher than they were this time last year, which was significantly above Wall Street expectations. So we're not seeing that pullback yet.
Nope.
In salaries and wages either.
Yep.
Yeah. I want to turn to, so that's like a little bit of like, you know, there's supply and demand, and there's enough demand that even as some people are being laid off and supply is created, they're getting sucked up. I want to turn, I'm going to use that as a pivot to come back to the New York City market dynamics and talk about our supply here of housing, bringing it back to our real estate HGAR topics here. Let's hear some of your respective thoughts on like, what do we see out there in supply? Cale, I may turn to you first. You've got a lot of perspective with sort of your stats and through Market Proof on what you're seeing in trends on supply.
Yeah, well, of course, I want to talk about rentals and tee something up for Jonathan.
Okay.
We had such a great,
That's why I love you, Cale.
yeah.
That's what-
So, I mean, I can talk about new development supply. It peaked in 2019. We burned off like 2,000 units. So there's like 12,000 left and like 5,500 units available in Manhattan. So there's still plenty of supply. Prices are stable. Yes, developers may have wanted more than they're getting, but still prices aren't going down. There's the summary. But, so
I like that you just took like 8 minutes of wisdom and was like, I've got this other exciting thing. So
yeah.
Yeah, here's the history of the world right here in 3 seconds.
But there's just been this
we
great
might come back to that, Cale, because I think there was a lot in there that our audience needs.
Okay.
To have in their hands.
All right.
Go with your lead. Go to the Jonathan thing. We're going to come back to that and walk through it a little bit more at pace. But
Well, there's been this great debate going on about what's happening with rentals. And a reporter from Curbed wrote this article.
Oh, yeah.
It was fascinating. I read it a whole bunch of times. And of course, Jonathan is quoted right at the top of the article.
Yeah.
About Manhattan rental prices. And then this reporter who's not in the business didn't pick up the phone and call me, didn't call Jonathan, didn't call Donna, or didn't call any of us to try to get more insight and get a source like real reporters do. This reporter just tried to figure it out. I don't remember if it was on their own, kind of trying to read, things, esoteric things.
Yeah.
And really got it all wrong. And then in the last couple of days, the Real Deal then stepped in and did a takedown of this Curbed article. So Jonathan, that was, it started with you.
Yeah, but it ended with me because I was in the second
wow.
article too. So for those of you who don't know, there's like this whole debate of like, after the pandemic, like, is the region devoid of people, right? Did they all move to Florida, right? And this person basically said, hey, I know that this data is wrong, but if you use it, then there's a lot of people missing. And I don't know, and I know this data is wrong, but if you use it, and he did that like she, I don't know, I don't remember the author, was like, and it made the rounds in New York City as an article, and Curbed is awesome, but this was like way off the mark. And so I reached out to a bunch of economists, chief economists of institutions to talk about like, have we lost, is this area like devoid of the people? Are we all office towers are 50% empty, that whole thing. But at the same time, we have record rents. We just dropped our rental report today on Manhattan, Brooklyn, and Queens. And guess what? Rents are not falling. They're moving sideways from summer records. And so what's that doing to housing prices? Just same thing that lack of inventory is doing. It's sort of pushing people into the rental market that were maybe priced out by the doubling of rates, or they want to see if prices will actually fall. And that's why I say it's going to be a disappointing year for those people. But anyway, then this article. So the takeaway generally is, I'm being completely honest, is that no one really knows what the net effect of the pandemic was. So one thing, and I don't want to get too in the weeds for the purpose of this call, but just one important point, just a takeaway, is when you look at all these reports, look at postal, change of address notifications to the post office, right? And just so you know, that is not a reliable way to look at migration because it does not factor in household growth, meaning, two people live together, and they split apart and one, you know, they get two places, it's not tracked. It's not in that data. And that was a big phenomenon, people doubling up or, you know, then wanting to get their own place. So anyway, it's still a mystery generally. And so we shouldn't think about like, hey, New York has been decimated and there's no people here, because the housing data doesn't show that. I guess that's my takeaway.
And also, Jonathan, I don't know if you saw on CNBC this morning, they did a whole little blurb on New York City rental.
That's
apartment
me.
rentals.
That's my data.
And that, right? So rents are up significantly and occupation is high. I'm sort of like, how can everybody think that
Right.
New York is decimated and everybody's gone if you can't get an apartment to rent, right? You would
Right.
think
It's a
that the rental buildings would be
dystopian
happen.
hellscape and nobody's here, is not the narrative. Like we're having the highest, like vacancy rate is 2.5%. If you average every January going back a decade, the average is 3%. Like vacancy is lower than the average. While inventory's up year over year, it's less than pre-pandemic. Like, you know, it's just showing you that there's a tremendous sort of in the metro area, people want to be here. One point that is largely anecdotal, and we know that the plural of anecdotal is not data, but one of the things that has become apparent anecdotally to me is that you know, you have a lot of renters here and they're working from home. And I remember on one of these calls 2 or 3 times ago where I was saying, you know, it's not about suburban, urban. Like people are in the city working remotely from their apartment in Manhattan to their job in Manhattan. Like none of that matters. But I think what no one's thinking about is that there are a lot of people from other cities. There was a white paper last fall that came out about remote work is causing higher housing prices. The reason is that people are living where they want to live instead of compromising to live near the subway or whatever the thing is. So you have people from Chicago want to live in Manhattan and they're living in Manhattan, but they're working remotely in Chicago, right?
Yep.
And they're paying more rent in Manhattan than they are in Chicago, but they want to live here, right? And they can do that. And that's what's different.
Yeah, I think that's true.
I'm glad I teed that one up.
Thank you,
Right?
Gail.
You're welcome. But Brian, I think, you know, the next set of things is really going to be government and what's going to happen. So there's a question that just came up in the chat around what's going to happen in Washington. But I really, you know, the issue related to housing in New York City is going to be from City Hall and the governor's office. And so you're seeing a lot of new proposals coming out. The Manhattan Borough President recently put out a report, which I can put a link to, identifying 170 some odd parcels that they identified as being ripe for development to bring new housing in.
Very pro-housing.
Pro-housing. And what's going to be required now? So, you know, we have these issues, and we all see how hard it is for people to understand what's going on. You know, we all do our best, right? We have our charts and our stats. But really, you know, the next phase is about government stimulus. Yes, there are all these office buildings. Yes, they are not as occupied as they once were. How do we, you know, what's going to happen to the taxes, the city's, you know, budget? Will there be enough money in their accounts to pay for all the stuff we need? They're going to have to stimulate things in certain ways, and that's got to be led by housing. So, you know, the 421A, I don't know if you're, I think this is
I feel like
what you were referring to earlier.
Yep.
You know, so a lot of people hustled to get shovels in ground in order to qualify for the 421.
Hey, Gail, what I might suggest for our audience here, maybe frame 421A briefly and then dive into it.
Yeah, so the simplest thing is that if you apply for 421A, then a portion of what you build has to be affordable. Affordable is defined by a percentage of the region's average income. So it's, I forget the exact numbers, 70% or 80%, Jonathan, I don't know if you know.
Yeah,
that.
there's all kinds of steps.
Different tiers.
Yeah.
And so if you reserve a portion, a percentage that's defined by the law for those income tiers, then you get big tax breaks. Without the developers will complain that without those tax breaks, the projects don't pencil out, they can't make any money. So in order to stimulate building more units, they put these things in place, and then developers are able to do it. So with the 421A, what happened is that developers rushed to get their projects started before the end date. But then with the increase in the interest rates, they couldn't get their projects financed.
You're stuck.
So they've got it, they've got a parcel, they've got it, begun, but they can't get what the money they need to actually build the building. And so New York City needs all this housing, and now we're in this, weird place where there's people who want to build stuff, but they can't. So the governor has proposed elongating the period by which the buildings need to get built. That's one solution. Whether or not it's going to be enough is still a big question. You got various zoning issues, and this is what the Manhattan Borough President is focused on, is changing the zoning so that these buildings can get built. You got the cost of capital, which is, as we've been talking about, got to be an issue still for a while. So we're in this very complicated place right now, which is going to really require some leadership. It's not out of Washington. This is really more local. And it's, we, not to jest, but we do have a governor and a mayor now who will talk to each other.
Yeah.
So we have a shot at it.
Yeah.
Right.
That's a
But
big
we also
improvement.
have a Senate and an Assembly who let 421 expire because of
Right.
political
Right.
grandstanding.
Yeah.
So I'm really hoping that with everybody agreeing that we've got a crisis when it comes to supply, that they'll get more realistic about having to come up with some kind of a replacement program.
Yeah. So it's really key. I mean, look, in the condo market, people aren't focused on building condos right now. There's plenty of inventory out there. People have shifted to building rental properties, multifamily, but now we have these various issues that, we just talked about. So we're in a bit of a standstill there too. We're still looking at a shortage. And if Jonathan's point is right, and I think it is, that it's not only people formation from local and regional, but also now you have international people coming back. Maybe I watch too much TikTok, but I see these guys interviewing people on the street, like, where are you from and what are you doing in New York? And, they're from all over. So, and they ask them, how much are you paying for rent? And the numbers are all very high.
Yeah.
So we have a very complicated thing going on. We don't have enough perspective to understand it yet. It's going to take a little more time.
Yeah. Cale, I want to go back to that sort of the burn down of shadow inventory, and that's sort of what had been, and the news had reported on, and you'd been quoted in a few New York Times articles and things around this oversupply sitting in the shadows of unsold developer condo units, right? So we go back a couple of years. You did this in 30 seconds or less. I'm going to give you like 3 or 4 minutes here. Walk our audience through that a little bit, because I think that burn down, which is good news. It's market intelligence for our audience here that's useful, helps influence some of these things we just talked about.
Yeah. So, coming out of the last cycle, there was a lot of concern that there were just way too many units available, and that the developers were keeping these things hidden in what we call a shadow inventory, which means the buildings are built, but the units aren't listed for sale. And that number peaked at like over 14,000 units
For just Manhattan?
No, in
New York City.
It's mostly Manhattan, but it's also to a degree in Brooklyn and in Queens.
Yeah.
So there was a lot of concern around that, and there was this very important New York Times article that came out from the reporter Stefanos Chen, who's a really talented reporter, and that really kind of broke the story publicly. into something that had been known inside the business for some time. But, you know, the combination of factors, you know, combined, the low rates, the desirability of some of these properties, the rise of Brooklyn, the rise of Western Queens. You know, you've seen, as I said, you know, the number of units has dropped by like 2,000. So
Mhm.
we're down to like 12,000 units, which is like 4.5, maybe 5 years of inventory available on the market. So you have fewer units, but also fewer transactions. So the sales, the absorption has decreased a little bit.
Mhm.
The market is pretty healthy, you know. So, you know, maybe, as I said, developers aren't getting every dollar that they wanted to, but the prices aren't going down.
Yeah.
Yeah.
If I could just
Yeah,
sort
go
of add
for it.
on to that, that's so clear. The way I think of shadow inventory is, you know, when you put up 100 units on the market, you're going to depress the price. So what you do is you put on 10 out of a 100-unit building. Principle of scarcity, right? You know, that they can dip into that shadow when they run low on the A line and they have more and they want to dip into it. The problem was that in Manhattan specifically, I don't cover all the boroughs the way Cale does. We went from, it would take almost 9 years to sell out unsold
Mhm.
condos to now it's like 3.5 years. And sort of a balanced lean market is like 2.5 to 3 years
Mhm.
based on sort of historical. And so we went from this wildly bloated a new development space to something much more closer to normal. And that was caused by this surge in demand caused by rates. And the other important thing when we think about the market, and I'm sure Marissa has thoughts on this too, because that's her bailiwick, is this sort of luxury, you know, skew after the pandemic hit that Manhattan inverted, where demand all of a sudden, instead of like this bloated top end, it reverted because the lower wage earners were much more economically punished during the lockdown and the early months than mid and upper tier salary people, which many hardly felt anything, and went out and bought real estate. And so what it ended up doing was the high-end market since the beginning of since 2020 has fared sort of historically in a much stronger way than we saw pre-pandemic, which for like 5 years was all about, you know, bloated supply and, you know, too much supply and a soft, slow moving high-end market. And it's not the case anymore. And this is not a New York thing. This is sort of a global thing and a US thing.
I think we talked about this in our session last week in preparation for this one. We all religiously on Monday read Donna Olshan's luxury report. And we talked about the fact that it seems like there are deals to be had, which may be another reason why that is, you know, moving some of that inventory. And Marissa, I'm just curious if you've seen that there's some good value and there are buyers who are recognizing that.
I think we're seeing buyers that are really interested in the high end of the luxury market. There's still, at least from my client base, there's still a lot of appetite there. And, you know, we can all talk about sort of where does that start? Is that a $4 or $5 million purchase? Is that a $20 million purchase, right? How rarefied do we want to look? But we're seeing a lot of activity in that space. In some ways, actually more activity, at least I'm seeing more activity in that space than in the lower end. I think in part that's because the others first of all, you're seeing the rich got richer, right, during the pandemic. So there are people with a lot of liquidity. There are people who haven't been spending the way they used to spend. And also, I think people are less excited to stay in a hotel in a post-COVID world. And if you can afford to have a beautiful apartment in a city, then, you're going to have one in New York and maybe one in Palm Beach and one in Aspen. And that's how you're going to travel and live your life rather than, stay at the Ritz-Carlton here and the Aman there. I also think the other thing that you're seeing is that, banks are looking for 20% down, right? A 10% down on a mortgage is not happening in this market unless you're in a sort of a CRA type of, Community Reinvestment Act type of mortgage. And the reason for that is even though Jonathan and Kale are going to sit here and say prices are not coming down, right? The credit committees at the banking firms are listening to everything we're talking about bringing down inflation, which brings bringing down prices, which means bringing real estate as a price. And so they're looking for individuals to put at least 20% down. And the higher end of the market, that's not a problem, right? They have that liquidity. And, some stepping in to buy their first apartment for $600,000 doesn't necessarily have 120,000 in the bank plus closing costs plus. And so I wonder if that drives, that's driving some of it as well. But we're seeing a lot of movement in the upper end of the market. And I would say, some of it are deals, but Central Park Tower is, I wouldn't necessarily call a deal, right? Like some of these numbers are still
Still in the thousands of
big and
dollars per square foot.
huge and getting really high premiums. So I think that's a little more building to building specific.
Yeah. I want to go to one
let
thing that,
me just jump every building is a market,
Yeah.
right? Central Park Tower is a market. They had an amazing January. But I'll also just add on, like particularly in Brooklyn at the lower end in January, things went really well. So
I've been actually in January, besides the uplift in the rental market, I've been seeing a lift in contract activity greater than I would expect in January in most of the markets that I cover. Like there's maybe it's just the New Year's thing, but it's more than seasonal. And also the narrative about housing seems to be pivoting a little bit from the, hey, sales are down 60% year over year to, hey, mortgage rates are in the high fives instead of 7, right?
I also think, Jonathan, you're definitely seeing that, right? It got really quiet in mid to late December. And
Yeah,
I would
fall.
say and early January. And the last 2 weeks or so, we're seeing a lot more activity, more interest, more conversations,
Yep.
and people signing.
right. Hey, with a couple minutes left, I want to acknowledge Karen's sort of question that went into the chat. So I'll let the panelists take a peek at it. It's got a lot of details and has to do with sort of the luxury rental market, and see if anyone has something they want to say. But I'm going to, one of my favorite podcasts just did a review of their January 2020 and their January 2021 predictions 21 and 22 predictions as they were now making their January 23 predictions. And they went through and sort of compared how they did. And since we've got 3 amazing panelists who we look forward to being together in January 2024 again, I want to hand the microphone to each of you to give one thought, one prediction. Jonathan, yours might be, if you want to use it, the sort of the year of disappointment. But I'm curious if each one of you is willing to put
I haven't
something out there.
trademarked that yet, so I don't know if
Okay.
I want to share that again. But
But what is a thing that you'd say that we can check back in on in January 2024 and see how things fared out against your forward-looking prognostic vision?
Sure. Well, from my standpoint, forget rate cuts and think about, and I'll make this a simple sentence, but I'm sort of leading up to it, is that that I actually think that we're going to have a reasonable seasonal pattern for 2023. I think we're going to see an uptick in activity in the spring, like we would expect. I think it'll be somewhat surprising to the real estate community about the transaction volume, but it's not a boom. But it's, you know, it's kind of like when you go to from the number 1 to the number 2, that's 100% increase, but it's not 100. You know, it's sort of out of context. And so I think the way I think of pricing, modest uptick in activity, and pricing moving sideways for a good part of the year, no recession.
Okay, there's a couple in there.
I know.
like
I was giving you a 3 for 1.
that's 3 for 1 day. I'll take it. You know, these days with inflation, what it is, I need all the 3 for 1 deals I can find.
Right.
Okay, Marissa or Cale, who wants to go next?
I'll go next. It's, you know, I love looking back at January 2021 because I was dead wrong. I mean, you know, I just didn't see what was coming. You know, there were a lot of developers we were really looking at going, oh my God, how is this? How are they going to get through this? And they were, and then, you know, as we've just been talking about, things really went really well, and everybody got through it and things went fine. Yeah, maybe their margins got pinched, but they got through it just fine. So, you know, where we sit right now, as I said, you know, the pendulum has swung a little bit in the other direction. And I agree with Jonathan, like the next, you know, I'm predicting we kind of get back to the trend line mid-year. After that, and where are we at January of next year, I have no idea. But I'm just looking right now to get to like back to the midline, which I feel comfortable that saying I think we can do by the middle of the year.
Okay. Okay. So the prediction is by the middle of the year, we're back on trend line.
Yeah.
I like it. Okay. Marissa, you get to close us out here.
I'll close us out. So First Republic's view is things are starting to normalize on the interest rate front, right? All of those crazy, shocking rates, right? It's not 2022. Put it that way. We're not going to go through that crisis, and clients are getting used to levels where they are. We do think, you know, all things being equal, which means Ukraine, Russia, you know, not another pandemic, right? All things sort of being stable. You know, two more rate hikes of, you know, 25 basis points each, and we level out and we stay there till year end. We really don't see any rate cuts coming in this year. I think buyers and clients are getting used to this level, and so the more we educate them, the more comfortable they are. And I think that we're seeing clients, you know, starting to look to finance again and seeing the value of financing and the value of getting back into the real estate market. And so I think things are going to start picking up.
Yeah, with that optionality of like buy with the rate you've got today and then update your rate when it's the right time.
Make sure you can SEMA, right?
Yep.
So
Yep. Make
that
sure you can SEMA, make sure you've got a good relationship banker.
Make sure you've got a relationship with a banker so that your pricing is the best that it can possibly be, so you can buy the nicest home that you can afford, and that you keep that relationship both with your agent, right, and your banker, so that as rates move in the coming years, everybody's ready to sort of be there to react and work with you.
Well, again, I want to say thank you to you all, as we're getting some thank yous for in the chat there. Another wonderful Be Your Best series. I do feel more well informed and sort of have better perspective on the year ahead. And we've got a couple prognostications that we're going to check back in on in a year. And thank you all for being here, Jonathan, Marissa, Cale. Richard, thank you as always for hosting. This was another great session. Thank you everyone in the audience for being here. And we look forward to seeing you next month on our next Be Your Best series.
Thanks, Brian.
Thanks, everybody.
Thank you, Brian and Richard. Thank you. Good seeing everybody.
Thank you, everybody.
Bye.